Now, bond markets have been decidedly yippy this week, to use President Trump's phrase. They're nervous about what he calls his big, beautiful bill. It extends the tax cuts from his first term. But in doing so, it adds $3 trillion to the nation's debts. And it's concerns over America's ability to pay that back that led to Moody's downgrading the US credit rating this week, the first time that's happened since 1917. When bond markets are unhappy, politicians have to take notice. Is it possible that the bond markets could do to President Trump what they did to Liz Truss? Well, since Evan and I started our chats on economic matters, quite a few people have actually asked about the bond markets and asked us to talk about them. And Evan, so this is
a good chance
to dive into it.
In bonds and debt.
Go on, we should start with what they are.
We should start with, so think of them as a bit of paper with simply an IOU that says the British government, for example, will pay you £1,000 in 2050. And obviously that's quite a nice thing to have because that means you get £1,000 in 2050. So that's a piece of paper, an IOU, and you can buy it. And when you buy it, that's how the British government borrows money. They sell these bits of paper. That brings the money in, and that's how they
And you're giving the government less than that now.
Right, and that's the crucial thing. You won't pay £1,000 to probably get £1,000 back from the government in 2050. You'll give something lower than that. And that difference is really the return you're going to make on your investment. Primarily, you buy it at a big discount, and then come 2050, you make a profit on it. And you can buy and sell these things in the second-hand market. You can trade it in early, and this is the bond market. It's the market in these bits of paper which are promises to pay in the future. And they're very important in the world because these government debts, which are predominantly government debts in this market, are considered an important safe investment for lots of savings institutions.
And that critical factor about safe investment, the safer the nation's debt is, if you borrow from the US government, what's the chance they're not going to pay you back? Means that you don't get as much back, but it should be safe as houses.
Correct.
But then, of course, the flip side of that is for nations that are might struggle to pay back, they have to pay more.
Right. So the crucial thing to remember about the bond market is that when the price in the second-hand market for these bits of paper that are being traded, when the price of the bond goes down, that's telling you people are kind of wanting to they need to be expecting a bigger profit when they get the money back later. So in effect, the price of the bond goes down, that's raising the cost, that's raising the cost of government debt, because when the government sells its IOUs, it's getting a lower price for them. And so there's a sort of inverse relationship between bonds go down, interest rates go up for the government. That's right.
Yeah.
That's the kind of...
And this is what often people get sort of flummoxed by, because you're talking about yields going up, which is a bad thing.
Yeah, yields going up means...
Which means the interest they're paying on it is higher. And that is a nightmare, for example, for Rachel Reeves at the moment.
Yeah, no. So these things can move around quite a lot. And when you've got $3 trillion of debt sitting out there, and you have to remember that debt may be 2050, but some of that debt's expiring every few months. You've got to roll it over. You're borrowing money this year just to pay your teachers, nurses, and your investments in HS2 or whatever. You're borrowing money for that. You're also having to borrow new money to roll over some of the debt from 1970 that is now expiring and needs to be replaced. So you're out there every couple of weeks raising money in new debt auctions, and if the price of those bonds goes down, you're getting a hell of a lot less in for the money you need.
Now, we have recent experience here in the UK of when the bond markets say, hang about, I don't like what you're doing as a government because it's not looking like you're going to be able to pay back so well. Yeah. This week, though, of course, we're seeing some nerves in the US bond market.
Yeah.
They're getting yippy.
Right, so what's been happening, it's quite interesting. The US bond market is different to other bond markets because investors all over the world will buy the US bonds, the treasuries as they're called. Ours are called gilts, theirs are called treasuries. People all over the world will buy theirs because they seem like a very safe bankable asset to keep. And so the Chinese, of course, have hundreds of billions of them. Actually, British investors have hundreds of billions. The Japanese have loads of this stuff. And these have been they've been, if you like, the kind of benchmark asset in the world for people to hold on to. And what has been happening over recent years is that foreigners are saying, I'm not so sure about the United States. I'm not quite sure I want to hold as many of these American assets as I've been holding. And President Trump potentially is accelerating that process. So at the moment in UK and US, about 30% of our government debt has been bought up and is held by foreigners, by non-Brits. And that number has been falling in the US. It's been rising for us. But the foreign holdings have been falling for the US. And I think there is a bit of concern that foreigners are thinking, we just don't know what's going on in the United States. And do we think of it as the sort of benchmark asset in the world as much as we did 10 years ago? Probably not. And so I think there is a worry that with people like Moody saying it doesn't look like there's any appetite for truly controlling the annual deficit in the US, which piles on more debt each year. With no appetite for that, we just don't know where it's going. And I think that's why international investors first and are kind of slightly just pulling back somewhat.
Okay. I mean, the last time the US paid off was under President Clinton, was when they were paying down, 2001.
Right.
It's just been rising pretty much. Well, it has been rising since then. Could the bond market force President Trump's hand, do you think?
Well, no one likes to be in the midst of a bond market crisis. I mean, what actually happens is suddenly you'll be finding that your tax income as a government, more and more of it, as the debt goes up and the cost of that debt goes up, i.e. the bond prices go down, more and more of your tax income is now having to just go on to paying the kind of the cost of debt, paying the interest bill. And so you have to sort of raise taxes to stand still when you get into that kind of crisis. So that's the general problem with big debts and high interest rates, is it uses up all your taxes on interest. And then the second, the really nasty stuff, which we had in the Liz Truss weeks, was when you get into kind of unpredictable market dysfunctions in which suddenly we found our pension funds were having to sell bonds because they'd got themselves into some complicated hedge arrangements that needed some cash quickly when bond prices started falling. And they had to sell bonds in order to pay out the cash. And so bond prices were falling. They were selling bonds. That made bond prices fall more. And you could get into a horrendous kind of market dysfunction. Sarah, we should say, actually, I'm talking like I know something about this. You actually worked in the bond market in a previous life. I think you should be telling us what...
Given that I worked for all of 6 months in the bond market, I don't think I've got too much to add, other than what really struck me. And in fact, in that time, I mean, I knew nothing. I knew absolutely nothing. But I was writing multi-million-pound sort of tickets for sales of Eurobonds, and not having a clue what I was doing. And I was that new girl who was incredibly irritable and sort of saying, why? I don't understand. Why, if interest rates go up, does this happen? And to be honest, none of these really seasoned, or at least you could see them thinking, I can't quite remember. Why is it? It was sort of an animalistic in a way. And you can kind of see that sometimes when the way the market moves is that, there's
momentum in it and it drives it. But look, let's just work out what drives bond prices. Number one is that risk of default, or that risk of it's out of control, government doesn't know what they're doing. That's where we were in the Liz Truss era. A danger for Donald Trump. But there are lots of other things. Look, if inflation goes up, suddenly the bond market will think, okay, interest rates are going to go up. So people aren't going to want bonds at 4% if interest rates are going to, short-term interest rates are going to be 6%. So inflation, definitely, inflation has an effect on bond prices. Higher inflation means lower bond prices. Default risk matters. And a sort of a worry about exchange rates can matter quite a bit too. If you think the dollar's going to fall, you don't want to be sitting on American government bonds because they're going to be worth less in your currency terms in in a few weeks' time. So there's lots going on in the bond market. It is a really interesting market to work in.
And how it's playing into the politics is very interesting because, of course, we have seen a pretty supine Republican Party, and yet the Republican Party are meant to be the ones who are concerned about finances. And this might be the thing because there has been a bit of sort of strong arming to try to get Congress to pass this big, beautiful bill that is going to add $3 trillion.
Republicans have been divided on this bill because some are saying in the Republican Party it pushes up debt too much. Mm-hmm. You've got the tax cuts, but you haven't cut spending. So they are saying we don't like this bill because it hasn't cut spending enough. Democrats don't like the bill because it cuts spending too much. And what's happened in the US is that paralysis between those who want lower taxes and lower spending and those who want effectively higher taxes and to keep spending up, that has just led to a paralysis on what you do about the deficit each year and the debt. And, the US deficit is about 6.5% of its national income. That means government is relying on 6.5% of the whole income is just the government's borrowing in that year. Now, that is uncomfortably high. Ours is about 4.5%. It's probably higher than you'd want it to be long term.
So that's what you're adding every year to the debt, which in the US is what?
Is about 110 or 112% of the... So the stock of debt, 110 or so percent of national income, they're adding, say, 6 or 7%.
So to come back to this question of the comparison with what, our experience and with Liz Truss's experience, can he beat the bond markets? I mean, he can withstand more, can't he?
Well, the American economy is a bigger player, and the Federal Reserve in the United States has more firepower to buy bonds if the markets are selling them too much. But
we did see him backtrack on tariffs as a result of the bond market.
And that was a bond market. I think that was more bond market
than anything else.
Stocks and your company shares. But look, no one would want to take on the bond market. And just remember, when we talk about the bond market, we're not talking about a bloke called Joe who sort of takes on President Trump. We're talking about lots and lots of independent players coming to independent decisions in multiple jurisdictions that they don't want to buy this stuff. And if they don't want to buy it, the American economy, like any economy, will be in trouble, and the dollar will fall and maybe fall more than the president wants, and it won't look good. So, I mean, can he take the bond market on? Well, of course, American president can take the bond market on, but I wouldn't want to bet on the winner on that.
Hence the James Carville quote. I used to think if there was reincarnation, I wanted to come back as the president or the Pope. Now I want to come back as the bond market. You can intimidate everybody.